January 2025. A supertanker carrying 2 million barrels of crude oil approaches the Strait of Hormuz, 21 miles wide at its narrowest point, the only route for 21% of the world's oil supply. On the bridge, the captain receives an alert. Regional tensions escalating, insurance premiums doubling, Lloyd's of London activating, war risk protocols. The tanker continues through because it has to. Because the alternative, rerouting around Africa, adds 6,000 miles, 3 weeks, and $2 million in fuel costs. The Strait of Hormuz isn't just a shipping lane, it's the most critical economic choke point on Earth. And when it closes, not if, but when, the consequences don't start with oil prices. They start with something most people never see: insurance. The Strait of Hormuz connects the Persian Gulf to the Arabian Sea. Through it flows 21 million barrels of oil per day, 30% of all seaborne traded oil. Nearly all exports from Saudi Arabia, Iraq, UAE, Kuwait, and Iran. If it closes, refineries from Japan to Germany face shortages within 40 days. But here's what the news doesn't tell you. The strait has closed before. Not completely, not permanently, but functionally. During the Iran-Iraq War, both sides attacked commercial shipping in the Gulf, over 500. Vessels were damaged or destroyed. And here's what happened. Oil didn't stop flowing entirely, but the cost of moving it exploded. Not because of supply shortages, because of insurance. Most people think tension rises to oil supply, drops to prices spike. That's not how it works. Here's the real sequence. Every commercial vessel carries insurance. Hull insurance, cargo insurance, liability, insurance. Standard maritime insurance excludes war risk zones. When tensions escalate in the Gulf, Lloyd's of London and other underwriters declare it a war risk area. Instantly, shipping companies must purchase separate war risk coverage. In normal times, $10,000 per voyage. During the 1980s, tanker war, $300,000 per voyage. Today, if tensions spike, estimates suggest $500,000 to $1 million per crossing. That cost gets passed immediately to whoever is buying the oil. Not in weeks, not in days, instantly. Some shipping companies decide the premium isn't worth it. They reroute around the Cape of Good Hope, around Africa, adding 6,000 miles. That's 3 extra weeks at sea, extra fuel, extra crew costs, extra time before cargo arrives. For a standard VLCC, very large crude carrier, the additional cost, $2 to $3 million. But here's the cascade. If 20% of tankers reroute, global oil supply doesn't drop 20%, it drops 5%. Because the other 80% are still getting through. But the market doesn't price in the 80% that's working. It prices in the fear that the remaining 20% might also stop. That's when oil futures spike. Not because oil is scarce, because certainty is. But insurance and rerouting are just the first layer. Because oil isn't just a commodity, it's collateral. And when collateral gets uncertain, debt gets expensive. Here's what most people miss. The largest oil producers in the Gulf, Saudi Arabia, UAE, Iraq, don't just sell oil for dollars. They borrow against future oil revenues. It's called reserve-based lending. A country or state-owned company proves it has X billion barrels in reserves. Banks lend. Against those future revenues, the oil becomes collateral for sovereign debt, infrastructure, bonds, development projects. When shipping through Hormuz becomes uncertain, something strange happens. The collateral doesn't disappear, the oil is still on the ground, but the certainty of delivering it to buyers vanishes, and banks don't lend against uncertain collateral. Brief tensions in the strait after Iran seized a British tanker. Saudi Aramco's bond yields spiked by 0.15% within 48 hours. That doesn't sound like much, but Saudi Arabia carries $70 billion in dollar-denominated debt. A 0.15% increase equals $105 million in additional annual interest costs for one 48-hour incident. Now imagine a full closure, or even a sustained period of uncertainty. Gulf nations wouldn't just face higher oil revenues from higher prices, they'd face higher borrowing costs, stalled infrastructure projects, delayed spending. Since the 1970s, oil exporting nations have used their surplus revenues to buy U.S. Treasury, bonds, European debt, and global assets. This recycling mechanism keeps global interest rates lower than they'd otherwise be. When Gulf oil revenues become uncertain, that recycling slows, not immediately, but within quarters. And when major buyers of U.S. debt pull back, even slightly, borrowing costs rise for everyone. U.S. mortgage rates, European government bonds, emerging market debt, all of it gets more expensive, not because the strait closed. Because the certainty that Gulf nations will keep recycling petrodollars has weakened. When oil becomes uncertain, debt becomes expensive. When debt becomes expensive, the entire financial system slows, not because oil stopped, because confidence did. This isn't theory, it's what happened in 1984. Because this pattern has precedent. And the precedent shows something critical. Markets don't wait for ships to stop. They react to the possibility. The tanker war is the only prolonged period when commercial shipping in the Gulf was systematically attacked. Here's what happened. Not in theory, but in documented fact. Iraq begins attacking Iranian oil exports. Iran retaliates by attacking vessels near Kuwait and Saudi terminals. March 1984, 53 ships attacked. By year's end, over 70 commercial vessels damaged. Oil prices spike, briefly, from $28 to $31 per barrel in 1984. Then they collapse. By 1986, oil is at $10. Why? Because Saudi Arabia flooded the market, increased production to offset the fear of supply disruption. But insurance costs stayed elevated for 4 years. War risk premiums remained 10 times to 30 times normal rates throughout the entire conflict. Shipping companies avoided the Gulf when possible, those that couldn't absorb the cost, or passed it to buyers. The physical flow of oil barely decreased, but the cost structure of global oil trade fundamentally changed for half a decade. Refineries locked in long-term contracts at higher prices to guarantee supply. Smaller nations without long-term deals faced chronic shortages, not because oil wasn't available, but because they couldn't afford the insurance and premium costs to secure it. India, Pakistan, parts of Southeast Asia all faced rolling fuel shortages despite global supply being adequate. Not a supply crisis, a financial access crisis. That was 1984. Today, the system is more fragile, not less. 3 things have changed since the 1980s. In 1984, average crude carrier, 100,000 tons. Today, VLCCs, 300,000 tons. ULCCs, 500,000 tons. One VLCC equals $200 million in cargo. Losing one ship removes $200 million and creates months-long insurance backlogs. 1980s, refineries kept 60 to 90 days crude reserves. Today, 30 to 45 days. Storage is expensive. Just-in-time reduces costs, but removes buffer. 30-day Hormuz disruption equals immediate shortages in Japan, South Korea, India. 1984, regional oil markets. Today, globally linked through derivatives, oil futures, CDSs on Gulf debt, shipping bonds, Hormuz tensions ripple through every energy-linked instrument. 2019, Saudi Aramco strike. Oil spiked 15% instantly, not from supply drop, but uncertainty. Sustained disruption equals margin calls, forced liquidations, credit spikes. In 1984, the world had time to adapt. Today, it has days, the buffer is gone. The interconnection is total, and the consequences don't wait for confirmation. Hour 1. A broker in London receives the alert. Lloyd's declares the Strait a war risk zone. Within minutes, premiums jumped from $10,000 to $800,000 per voyage. On trading floors in Singapore, oil futures spiked 12%, not because supply dropped, because the cost of certainty just tripled. Day 3. A shipping executive in Athens makes a decision, reroute around Africa. 3 extra weeks, $2.5 million in additional costs, but cheaper than the insurance. 20% of tankers make the same choice. Week 1. Asian refineries calculate reserves. 30 to 45 days before shortages. Lock in long-term contracts immediately. Oil spikes another 20%. Week 2. Gulf borrowing costs rise. Bond yields spike. Projects pause. Petrodollar recycling slows. Global interest rates tick up. Week 3 to 4. Smaller nations face price lockouts. Not oil scarcity, financial access. Fuel rationing begins. Pakistan, Bangladesh, parts of Africa. Month 2. Refineries shut units. Not out of oil. Economics don't work at elevated costs. Gasoline, prices spike, inflation accelerates. Month 3 plus. It persists, structural adjustment. Industries contract. Shipping reroutes permanently, debt, restructured. History shows, by month 3, either resolution or adaptation, not by replacing oil, by reducing demand, recession. The Strait of Hormuz isn't just about oil supply. It's about the financial infrastructure that moves oil from producers to consumers, insurance, debt, derivatives, contracts. When that infrastructure breaks, it doesn't matter how much oil exists. What matters is who can afford to move it, and who gets left out. The 1980s tanker war showed this clearly. Global oil supply barely dropped, but the financial cost of moving oil stayed elevated for years. Smaller nations faced chronic shortages. Gulf states restructured debt. Shipping companies went bankrupt, not because of supply, because the cost structure of global trade had fundamentally changed. Today, the system is more interconnected, more fragile, more dependent on just-in-time certainty, which means the consequences arrive faster and last longer. The Strait of Hormuz is 21 miles wide, but the economic choke point it represents is global, and when it tightens, the world doesn't run out of oil. It runs out of affordable access to it. That's the difference between a supply crisis and a financial one, and it's the difference most people don't see until it's already happening.